Now, what's a dividend? So some companies, when they make profits, they actually share a cut of those profits directly with their investors just for holding the stock. You don't sell anything. You don't do anything. They just send you money every quarter like clockwork. That's a dividend. Passive income while you sleep. Your portfolio is just the collection of everything you own. All your stocks, ETFs, index funds, all of it together. That's your portfolio. Now, risk versus return. This is the one rule that will protect you from every scam you will ever come across in your life. Higher potential return always comes with higher risk. No exceptions, ever. So when someone walks up to you and promises guaranteed 50% returns with zero risk, you already know exactly what that is. It's a lie. Real investing has real risk, and real investing has real reward. But nobody on this planet can hand you maximum reward and zero risk at the same time. Remember that. Forever. Now, bull market versus bear market. Bull market means prices are going up. The economy is growing. People are feeling good. Everybody suddenly thinks they're a genius investor. Bear market means prices are falling. Fear is creeping into everything. People are panicking, selling, running. Here's what you need to know about both of them. They are both completely normal. They are both temporary. And they have both happened over and over throughout all of history. The investors who stay calm through both win. The investors who panic during bear markets lose. Simple as that. Diversification. Never put all your eggs in one basket. Spread your money across different companies, different sectors, different types of assets. So if one thing crashes, everything else doesn't go down with it. And finally, asset classes. These are just the different categories of things you can actually invest in. Stocks, bonds, real estate, gold, crypto. Each one reacts differently to what's happening in the economy, and a strong portfolio, built over time, has a healthy mix of these. You don't need to stress about all of them right now, but just knowing they exist means you'll never be lost when someone mentions them, okay? You just learned in 5 minutes what most people spend years being confused about. But knowing the terms is only half the battle, because now you need to know, how do you actually look at an investment? Before you put your real money into it, how do you know if something is actually worth buying? That's exactly what's coming next. And trust me, it's way simpler than anything you've been told before. Okay, so now you know what everything is, but here's the question that nobody actually answers. How do you know if something is worth your money? Because just knowing what a stock is doesn't tell you if that stock is a good investment, and just knowing what an ETF is doesn't tell you if that ETF is worth buying. So let me walk you through exactly what to look at, and I promise this is way simpler than the finance world wants you to believe. Let's start with stocks. When you're looking at a stock, the very first thing you want to ask is this company actually growing? Look at their revenue. That's just the total money the company is bringing in. Is it going up year after year? Or is it flat? Or worse, company that keeps growing its revenue is a company that keeps getting more valuable. Next, profit margins. Revenue is how much they make. Profit margin is how much they actually keep after all their costs. A company can make $1 billion in revenue and still be losing money. So you want to see healthy profit margins. The more they keep, the stronger the business. Then, debt levels. How much does this company owe? A little debt is normal. Too much debt is dangerous, because if the economy slows down and they can't pay their debt, the whole thing can collapse. Think of it like a person. Someone with a small, manageable mortgage, they're fine. But someone drowning in credit card debt, one bad month away from disaster. Same with companies. Now, the PE ratio, price to earnings. This sounds scary. It's not. It simply tells you, how much are you paying for every dollar of profit this company makes? If a company's PE ratio is 20, it means you're paying $20 for every $1 of profit they earn. Is that good or bad? Depends on the industry. But generally, lower PE means you're getting more value for your money. Higher PE means the market expects big future growth. And finally, the most important question of all, will people still need this? In 10 years? Does this company solve a real problem? Does it have real customers? Is its business model built to last? Because you're not trading, you're investing. And investing means you're thinking long term. a company that solves a real problem that people will still need a decade from now, is a company worth owning. Now, what about ETFs and index funds? This one is much simpler. The main thing you look at is the expense ratio. That's just the annual fee the fund charges you to manage your money, and you want this number to be as low as possible. The best index funds in the world, like Vanguard's VOO or Fidelity's FZROX, charge almost nothing. We're talking 0.03% or even zero. That might sound tiny, but over 30 years, a high expense ratio quietly eats thousands of dollars of your returns. Low expense ratio, always. Then look at what index it actually tracks. Is it the S&P 500, the total market, a specific sector? Know what you're buying, and look at its historical performance, not as a guarantee, but as a reference. How has it behaved over time? How did it recover after crashes? And then, for any investment you ever consider, ask yourself this one question. What is my worst case scenario, and can I survive it? If the answer is yes, you proceed. If the answer is no, you don't. It's that simple, because smart investing is not about finding the best possible outcome. It's about making sure the worst possible outcome doesn't destroy you. Now, here's something I need you to understand. Before we go any further, I've seen people who knew everything I just told you still lose money, not because of bad stocks, not because of bad funds, because of something much harder to control, themselves. And that's exactly what we're talking about next. Let me be completely straight with you. Most people who learn everything I've taught you today will still not build wealth, not because the strategy is wrong, because of what happens inside their head when things get hard. So here are the 4 rules that actually decide everything. 1. The market will crash. Plan for it now. 2001, 2008, 2020. It crashed. It recovered. It went higher. Every single time. When it crashes again, and it will, your only job is to do nothing. Keep contributing. Stay calm, because a crashing market is just everything going on sale. The winners buy during crashes. The losers sell. 2. Never invest money you can't leave alone for 3 to 5 years. No exceptions. If you need that money, that's right. It has no business being in the market. Keep it liquid. Keep it safe. Only invest what you can truly walk away from. 3. Stop checking your portfolio daily. Daily checking creates daily emotions. Daily emotions create bad decisions. Bad decisions destroy returns. Once a month, that's it. 4. Fear and impatience are your only real enemies. Not the market, not the economy, not Wall Street. You. Fear sells at the bottom. Impatience buys at the top. Together, they guarantee you lose. The fix? Automate everything. Trust the process. Ignore the noise. The greatest investors in history weren't smarter than everyone else. They were just calmer. Now, get everything emotional for a second, because I want to show you cold, hard numbers, math behind $100 a month, becoming $1 million. And once you see it, you'll understand why starting today, not tomorrow, not next month, not when you feel ready, today is the most important financial decision of your life. Okay, here are the numbers, and I need you to actually sit with these, because most people hear this and let it go in one ear and out the other. Don't do that. Let's start simple. You invest $100 a month. That's it. $100. The cost of a few dinners out, a couple of subscriptions you probably forgot you even had. You put that $100 every single month into a simple S&P 500 index fund, and you leave it alone. The S&P 500 has historically returned an average of 10% per year over the long term. Not every year. Some years it's up 25%. Some years it's down 30%. But averaged out over decades, it's been around 10%. So what does $100 a month at 10% average return actually become? In 10 years, $20,000. In 20 years, $75,000. In 30 years, $226,000. From $100 a month. You didn't get a raise. You didn't start a business. You didn't do anything except stay consistent. But here's where it gets interesting. What if you increase that to $300 a month in 30 years? That becomes $678,000. $500 a month, over $1 million. $1 million from $500 a month. That is not a fantasy. That is not a get-rich-quick scheme. That is just arithmetic. Compound interest, doing exactly what it was always designed to do. Remember that snowball we talked about earlier? This is what it looks like when it reaches the bottom of the hill. Now here's the part that most people skip over, and it's the most important part of this entire video. Cost of waiting. Let's say you're 25 right now. You start investing $300 a month today. By the time you're 55, you have $678,000. Now, let's say you wait just 1 year. You start at 26 instead. Same $300 a month. Same 10% return. By 55, you have $612,000. You waited 1 year. It cost you $66,000. 1 year, $66,000. Gone. Permanently. No way to get it back. That's not a scare tactic. That's just how compound interest works. The longer your money has to grow, the more ruthlessly it multiplies. And the longer you wait, the more ruthlessly that opportunity disappears. Now, I want you to think about something for just a second. How many months have already gone by where you thought about starting, but didn't? 6 months? A year? 2 years? I'm not saying that to make you feel bad. I'm saying it because every single month from this point forward is a month you control. You cannot get back the months behind you, but you own every single month ahead. And the best time to start was yesterday. The second best time is right now. Today. Not when you have more money. Not when the market feels safer. Not when life slows down. Right now. Because here's the truth that ties everything together. You don't need to be rich to invest. You don't need a finance degree. You don't need to understand every term on Wall Street. You just need to start. Stay consistent and let time do what it has always done. Turn small, consistent actions into life-changing wealth. That's the whole game. And now, you know how to play it. Okay, stop for a second. Think about where you were at the beginning of this video. You clicked this, not really knowing what investing was. Maybe a little scared. Maybe a little embarrassed that you hadn't started yet. Maybe just tired of feeling left behind, while everyone around you seemed to have it all figured out. And look where you are now. You understand what investing actually is, not the textbook definition, the real one. You know the order. You know the terms. You know how to look at something before putting your money in. You know the emotional traps that destroy most investors before they ever get going. And you've seen the actual math, the real numbers, that prove this is not a dream. It's arithmetic. That's a completely different person than who clicked play. And honestly, most people never get this far. They watch half a video, get overwhelmed, and quit. You didn't. That already puts you ahead. But here's what I know about this journey. The more you learn, the more you realize how much more there is to learn. And that's actually exciting, because every new thing you understand compound, just like your money. So if you felt something shift in you today, if something finally clicked, then this channel is exactly where you need to be, because we are going deep every week, breaking down the things nobody taught us in school, the things the wealthy already know, the things that actually move the needle when you're building from nothing. Subscribe, turn on notifications, and come back, because the people who stay are the ones who win. I'll see you Thursday. Quick note before you go. Everything in this video is for informational and educational purposes only, and reflects my own personal perspective. This is not financial advice. Always do your own research, and consult a licensed financial professional before making any investment decisions. Your money, your choices, always.